Bitnile has been trending in popularity recently, and many people are asking themselves if they should purchase more, sell their current position, or stand on the side to wait for a better timing. As the market is still very volatile at the moment, we should be careful about which stocks to pick, as well as the exposure and the timing of our positions. Over the past few days, the price action of NILE has brought the stock price to 95 cents before stabilizing around 54 cents. The short-term price trend of Bitnile has been bearish, but bottoming in my opinion. The market has sent the share price of Bitnile to a relatively low place, but so far it has yet to touch the 50 cents level, which proved to be a fairly reliable rebound place before. When we look at the long-term price trend of Bitnile, it has been bearish. The company's fundamentals and the fact that the crypto market's own volatility may impact the performance of the company have both played a role in the negative growth. The other issue that Bitnile is likely facing is that it is categorized as a speculative stock in the trader's mind. When the Nasdaq is having a tough day, it's more than likely that Bitnile may also get impacted at the same time. Now, let's also take a look at the technicals of the stock. The trading volume of Bitnile has recently been 28 million shares, compared to the average volume of 65 million shares. Over the previous 52-week period, its price fluctuated between 50 cents and $3.70. The market cap of Bitnile is currently at $46 million versus an enterprise value of $58 million. The difference between the market cap and the enterprise value is the premium or the discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts or a negative image amongst market participants, the assets value may be impaired. With that being said, at the end of the day, it remains an estimation of the market every time it publishes the financial statements, and it's also less reactive than the market cap. One key element to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they may own is the goodwill. Goodwill is an expectation of the market that the company is able to generate more profit or to have more growth than another company, partially because it may have a better management, a stronger brand recognition, and a bigger online following. It is what is unique about a company compared to the alternative competitors. In other words, it's not a tangible asset that companies may use. It is, however, often the reason that some companies are perceived to be trading at a discount because the market cap may be lower than the enterprise value, as it's also less reactive than the market cap in volatile situations. If the company goes to liquidation, the bondholders and the shareholders would be left with far less assets than whatever that is written on the balance sheet at the moment, since the goodwill and any sort of intangible would be gone. When we compare the current price to the historical price fluctuations, the stock is 11% higher than the 1-month low, 11% higher than the 12-week low, and 11% higher than the 52-week low. On the options market, giving a hint about the market sentiment about where the stock price is likely going to go next, the implied volatility is 331% versus a historical volatility of 172%. The put-call volume ratio is currently at 0.04. It is normal for many stocks to also have a higher put option volume than what they deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 6,000 contracts a day versus the 30-day average of 13,000. Regarding the open interest, the most recent volume of open interest is 156,000 contracts versus the 30-day average of 95,000 contracts. In terms of shareholder structure, institutional shareholders own about 15% of the outstanding shares. The biggest shareholders include Vanguard, BlackRock, and Renaissance. It's relevant to understand the shareholder composition of a company, as this often helps to determine if you should hold the stock long-term or to simply view it as a short-term trade opportunity. If the stock is mainly held by retail traders, this may be a sign that the stock lacks the depth to justify long-term trust from shareholders. The typical consensus is that there should be between 25 to 30% of institutional participation for the stock to be perceived as an investment and not a position. This is obviously subject to a lot of exceptions, since many great titles are also mostly held by retail investors and not the institutional ones, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price goes lower. Sometimes when there are significant short interest in the total volume, this is an important sign that something organized may be going on, like what has been going on with GameStop and AMC. The current short interest is 12% of the total floats, and 53% of the transactions coming out of the dark pools. Usually, if the short interest is above 15% of the total volume, and a significant chunk of that volume coming out of the dark pools, this is a sign that institutional positions are being taken to short the stock, and that should tell you that there is real potential for short squeeze. Given the analysis above, my suggestion for NILE or Bitnile is that I would say that a position should be taken now so that you can benefit from the relatively low price level, which is also a very low level historically speaking. And even if the stock doesn't get back up in the very short term, at least the downside is very, very limited. And even if it just retraces back up, you would still be making enough to make your while worth it. I would suggest a maximum exposure between 3 to 5% of your portfolio. And I would also recommend to split your allocation in batches of 25% at a time so that you may purchase more if it retraces further. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.